Have you ever wondered if investing is something you could or should do? Let's debunk a common myth right off the bat. Investing isn't just for the well-heeled or Wall Street wizards. It's a tool that's accessible to everyone. Yes, that includes you too. Investing can be a powerful way to grow your wealth over time. It's like planting a seed and nurturing it to grow. Your money, much like that seed, can grow given the right conditions. It can help you save for future goals like a comfortable retirement or your child's education. Moreover, investing can help you stay ahead of inflation. Picture this. Your money sitting in a savings account is like an ice cube under the sun. Over time, it shrinks due to inflation. But with investing, you have the opportunity to beat inflation, keeping your money's purchasing power intact. Investing can be for anyone, and it's never too early or too late to start. Before diving into investing, it's crucial to understand a few basic concepts. Let's start with stocks. Stocks represent ownership in a company. When you buy a stock, you're buying a piece of that company, essentially becoming a shareholder. Bonds, on the other hand, are like loans that you give to an organization, typically a government or a corporation. In return, they agree to pay you back the amount you lent, plus interest, at a predetermined date. Mutual funds and ETFs, or exchange-traded funds, are another way to invest. These are essentially baskets of different stocks, bonds, or other assets. They allow you to diversify your portfolio, spreading your investments across many different areas, which can help manage risk. Now, speaking of risk, it's important to know that all investments come with some level of risk. Stocks, for instance, can fluctuate in price. A company you invest in could do well, and the value of your stocks could rise. But if the company doesn't do well, the value of your stocks could fall. Bonds, while generally considered less risky than stocks, also carry risk. For example, the organization you lend to might not be able to pay you back. Mutual funds and ETFs, while offering diversification, are not immune to risk either. Their value depends on the performance of the different assets they contain. The flip side of risk is return. Return is the money you earn from your investments. This could be in the form of dividends from stocks, interest from bonds, or capital gains if you sell an investment for more than you bought it for. The potential for high returns is what makes investing so appealing. But remember, the possibility of higher returns generally comes with a higher level of risk. It's all about finding the balance that's right for you. With these basic concepts, you're now better equipped to start your investing journey. Identifying your investment goals is the first step in your investing journey. Just as a sailor needs a destination before setting sail, an investor needs clear, achievable goals before diving into the wide ocean of investments. Without a goal, you're like a ship without a compass, drifting aimlessly in the sea. Setting clear goals helps to guide your investment decisions. It's like having a roadmap that points you in the right direction. Let's say, for instance, you're saving for retirement, a down payment on a house, or your child's college education. Each of these goals requires a different investment strategy, time horizon, and risk tolerance. By understanding what you want to achieve, you can tailor your investments to meet those specific goals. This could involve choosing between stocks, bonds, or mutual funds, or deciding how much risk you're willing to take on. Remember, your investment goals will guide your investment decisions. Every investment decision you make should bring you one step closer to your desired destination. With goals in place, it's time to create an investment plan. Creating an investment plan is like laying out a map for your financial future. It's a critical step in making your hard-earned money work for you. But where do you start? Well, let's break it down into 3 key factors: diversification, risk tolerance, and time horizon. Diversification is about not putting all your eggs in one basket. It's spreading your investments across different asset classes such as stocks, bonds, real estate, and perhaps even cryptocurrencies. Why is this important? Because when one asset class is doing poorly, another might be performing well, balancing out your overall returns. Next, let's talk about risk tolerance. Everyone's level of comfort with risk is different. Some of us might be thrill seekers, ready to dive headfirst into high-risk, high-reward investments. Others might prefer a slower but steadier growth. Knowing your risk tolerance is about understanding how much volatility or market fluctuation you can stomach without losing sleep at night. Then we have the time horizon. This is simply how long you expect to invest before needing to access your funds. If you're saving for retirement and you're in your 30s, your time horizon might be 30 years. But if you're saving for a down payment on a house in 5 years, your time horizon is significantly shorter. Your time horizon influences the types of investments suitable for your plan. Now, creating an investment plan can be complex, and it's okay to seek help. A financial advisor can provide personalized advice based on your unique situation. Alternatively, a robo-advisor can offer algorithm-based investment management, often at a lower cost. Both can guide you in setting up and fine-tuning your investment plan. Remember, an investment plan isn't set in stone. As your life changes, so too should your plan. Regularly review and adjust your plan to ensure it stays aligned with your goals. A well-thought-out investment plan can help you reach your financial goals. With patience, perseverance, and a solid plan, you're well on your way to building your financial future. Now comes the exciting part, choosing where to invest your money. As you embark on this journey, there are several factors to take into account. Let's break them down. Firstly, consider the performance history of the potential investment. This doesn't mean you should only choose investments with high past returns. Remember, past performance is not a guarantee of future results. However, it can give you a glimpse into how well the investment performed under various market conditions. Secondly, fees are a crucial factor. Every investment has costs associated with it, such as transaction fees or management fees. These can eat into your potential returns, so it's worth taking the time to understand what you're paying for. Next, alignment with your investment goals is paramount. If you're investing for the long term, you'll likely want to look at investments with the potential for growth over time. Alternatively, if you're investing for income, you might be more interested in investments that provide regular dividends or interest payments. So, how do you find this information? Welcome to the world of research. There's a wealth of information available at your fingertips, from company reports and financial news to investment blogs and forums. Start by reading about the company or fund you're interested in. Look at their financial statements, their business model, and their future plans. Also, consider the market environment and economic indicators. For instance, if the economy is booming, it might be a good time to invest in growth stocks. On the other hand, if the economy is in a downturn, you might want to consider more conservative investments. However, remember that research is not just about reading numbers and graphs. It's also about understanding the story behind the investment. What is the company's vision? What are its strengths and weaknesses? How does it fit into the broader market landscape? It's a lot to take in, but don't worry. Investing is a journey, and every step you take brings you closer to your financial goals. Choosing the right investments is a critical step in your investing journey. Investing isn't a set-it-and-forget-it activity. Monitoring your investments is key. It's like planting a garden. You don't just sow seeds and walk away, do you? No, you water them, protect them from pests, and sometimes you even need to prune them to help them grow better. The same goes for your investments. Your investment portfolio isn't a static entity. It's a dynamic, ever-evolving cluster of your hard-earned money, and it needs your attention. Regular portfolio reviews are crucial. These reviews are akin to your garden checkups. They help you understand how your investments are performing and whether they're on track to meet your financial goals. But here's the catch. Monitoring doesn't mean constantly fiddling with your investments. It's not about buying and selling stocks every other day based on the latest market rumors. This approach, known as frequent trading, can be dangerous for beginner investors. It's like overwatering your plants or overpruning your shrubs. Too much of it can do more harm than good. Each transaction comes with costs, and frequent trading can eat into your returns, leaving you with less than what you started with. Instead, adopt a long-term perspective. Look at your investments as trees that need time to grow. Some might bear fruit earlier than others, and that's okay. The goal is to have a thriving garden in the end, not just one or two high-yielding plants. This means sticking to your investment plan, even when the market gets a little stormy. It means having patience and not being swayed by short-term market fluctuations. Remember, it's okay to make adjustments as needed. If a particular investment isn't performing as expected, it might be time to consider alternatives. But these decisions should be based on careful analysis and not just knee-jerk reactions to market movements. To sum it up, monitoring your investments is about balance. It's about knowing when to hold on, when to let go, and when to make changes. It's about being patient, being consistent, and most importantly, being informed. Remember, investing is a marathon, not a sprint. So, what have we learned about investing today? We've seen that investing is not a closed club. It's accessible to anyone with a little dedication and time. Understanding basic investment concepts is crucial. It's the foundation of your financial journey. We've also learned about the importance of setting clear, attainable investment goals. This is your roadmap, your guiding star. We discussed the significance of creating an investment plan that aligns with your goals. This is your vehicle, driving you towards your destination. We also stressed on the importance of choosing your investments wisely. It's about making informed decisions, not just following the crowd. Lastly, we touched on the necessity of regular monitoring of your investments. It's not enough to set it and forget it. You need to keep an eye on your portfolio, adjusting as necessary. With these simple steps, you're well on your way to becoming a savvy investor. Remember, investing is a journey, not a destination.